The Strait of Hormuz just changed forever. In the dead of night, 7 elite Navy SEAL and Marine Raider teams moved silently beneath the Persian Gulf's surface, and by dawn, the most dangerous mine manufacturing operation in the Middle East was gone. Not damaged. Gone. This is not a rumor circulating on social media. This is the operation that oil traders, Pentagon insiders, and 3 central banks were watching in real time. Because what happened inside that facility did not just end a military threat, it moved markets, it shifted alliances, and it sent a message that every government from Beijing to Brussels immediately understood. Let me take you inside what actually happened, what it cost, what it means for your economy, and what is coming next, because the mainstream media is only showing you the surface of this story. For weeks, U.S. intelligence satellites had been tracking unusual thermal signatures deep within Iranian-controlled territory near the northern entrance of the Strait of Hormuz. Analysts at the National Geospatial Intelligence Agency flagged the activity as consistent with large-scale naval mine assembly. These were not simple contact mines. According to defense sources familiar with the intelligence, these were sophisticated bottom-influence mines, designed to detect the acoustic signature of aircraft carriers and supertankers alike, capable of sitting dormant on the ocean floor for months before activating. The Iranians had been building them quietly, and they had been positioning them even more quietly. The Strait of Hormuz is 21 miles wide at its narrowest point. 21 miles. Yet through that corridor flows approximately 20% of the world's entire oil supply every single day, 17 million barrels, every morning. When that strait is threatened, the entire global economy holds its breath because a blockade there does not just raise gas prices in Texas or London, it triggers sovereign debt crises in import-dependent nations, collapses shipping insurance markets, and sends defense contractors' stock prices into the stratosphere, while everyone else watches their retirement funds bleed. The Pentagon had been wargaming this scenario for over a decade. They had contingency plans, countermine task forces, and specialized marine mammal units trained for exactly this environment. But when the intelligence came in showing that the factory was nearly at full operational capacity, the decision was made to act before a single mine hit the water. That decision came from the highest levels, and it came fast. 7 teams were deployed. SEAL team operatives and Marine Raiders, the most elite special operations units the United States military fields, moved into position using a combination of submarine insertion and ultra-quiet combat diving equipment. The operation was coordinated with Air Force electronic warfare assets that blinded Iranian radar across a critical 40-minute window. Satellite communications were jammed in a precise pattern, and the teams moved through that silence like ghosts. What they found inside that facility was larger than expected. The manufacturing floor held an inventory that, according to early assessments, could have seeded the strait with enough mines to halt commercial shipping for 6 to 8 months. 6 to 8 months. Run that number through an economic model, and the output is catastrophic. The International Monetary Fund has previously estimated that a sustained Hormuz blockade would trigger a global recession within 90 days. Oil would spike past $240 per barrel within the first 2 weeks alone. The cascading effects on food prices, fertilizer supply chains, and energy-dependent manufacturing would be felt in every single country on Earth. The teams neutralized the facility with surgical precision. Explosive ordnance disposal specialists rendered the assembled mines inert before demolition charges brought down the structural elements. The operation lasted less than 3 hours from first insertion to final extraction. Every operator came home. That last fact is not a small detail. That is a statement of operational excellence that the intelligence community will be studying for years. Now here is where the story becomes about more than just military power, because what happened immediately after that operation tells you everything about the real game being played. Within 6 hours of the facility's destruction, Brent crude dropped $4.12 per barrel. $4 in 6 hours. That single price movement represented tens of billions of dollars shifting hands in commodity futures markets. Certain institutional investors were positioned for exactly that move. The options market activity in oil futures in the 72 hours preceding the operation showed unusual clustering of put contracts at very specific strike prices. That is not a coincidence. That is intelligence leaking into financial markets the way it always does, quietly, profitably, and just below the threshold of regulatory scrutiny. This is the hidden money flow that nobody in mainstream media will connect for you. Wars and military operations do not just happen in a geopolitical vacuum. They happen inside a financial ecosystem where advanced knowledge of military action is worth more than any single stock tip in history. The people who knew this operation was coming did not tweet about it. They bought contracts. And when the news broke and the strait opened back up, they cashed out. This is the intersection of war and money that defines our world, and it is the intersection that WarFinex exists to expose. But let us zoom out even further, because the strategic implications of this operation extend far beyond a single facility and a single commodity price movement. Iran's ability to threaten the Strait of Hormuz has been the cornerstone of its deterrence strategy for 30 years. It is the leverage Tehran uses in every nuclear negotiation, every sanctions conversation, every back-channel diplomatic exchange. The implicit message has always been, push us too far, and we close the strait. Now, with 7 teams having demonstrated that the United States can reach inside Iranian territory and surgically eliminate that capability before it even deploys, that leverage is fundamentally weakened. Tehran's negotiators know it. Moscow knows it. Beijing knows it most of all. China is the largest single beneficiary of Gulf oil exports. Approximately 40% of China's oil imports pass through Hormuz. For years, Beijing has been quietly expanding its naval presence in the Indian Ocean and building relationships with Gulf states precisely because it understands how exposed it is to disruption in that corridor. This American operation forces Beijing to accelerate its contingency planning, which means more investment in domestic energy alternatives, more diplomatic pressure on Gulf states for bilateral deals outside the dollar system, and more urgency around its strategic petroleum reserve expansion. Every one of those moves has a price tag and a geopolitical consequence. For the United States and its allies, this operation is a demonstration of something critically important heading into a period of intensifying great power competition. It proves that American special operations capability remains capable of projecting decisive force into denied environments with low signature and high effectiveness. That matters enormously for deterrence calculations in other theaters, from the South China Sea to the Baltic, from the Korean Peninsula to the Taiwan Strait. Adversaries do not just calculate military power based on carrier groups and missile counts. They calculate it based on demonstrated willingness and demonstrated capability. Tonight, both of those columns just got updated. The economic aftermath is still unfolding. Shipping insurance rates, which had spiked 38% above their 12-month average due to mine threat assessments in the Gulf, began correcting almost immediately after the news confirmed the operation's success. Lloyd's of London war risk underwriters, who had been quietly pulling coverage from certain Gulf routes, are expected to restore standard terms within the next billing cycle. That alone saves global shipping companies an estimated $400 million per quarter in premium costs, savings that ultimately flow back into the price of everything that arrives in a container at your local port. Middle Eastern sovereign wealth funds, particularly those of Qatar and the UAE, had been quietly diversifying away from Gulf-exposed assets over the previous 6 weeks. That capital, estimated in the range of $60 to $80 billion, is now expected to partially reverse course, flowing back into regional infrastructure and energy projects. The Saudi Aramco board, which had been delaying a major capital expenditure decision related to Red Sea and Gulf shipping infrastructure, is now expected to move forward. These are the downstream financial consequences that connect a 3-hour military operation in the dark to the price of fuel at your pump and the value of your investment portfolio 6 months from now. What comes next is where it gets genuinely unpredictable, and this is where you need to pay very close attention. Iran will respond. The question is not if. The question is how, when, and through which proxy channel. The most likely near-term response involves acceleration of drone and missile stockpiling by Hezbollah in Lebanon, increased pressure on Houthi forces in Yemen to target Red Sea shipping, and a renewed push through Iraqi militia networks to challenge U.S. bases in the region. None of these are equivalent in scale to what was just taken from Tehran, but collectively they represent a sustained pressure campaign designed to raise the cost of American operations without triggering a direct military escalation that Iran cannot win. The financial markets will reprice risk across the entire region over the next 30 to 60 days. Defense sector equities, particularly those exposed to precision munitions, underwater warfare systems, and electronic warfare, are worth watching closely. The same geopolitical pressure that created the mine factory threat in the first place has not gone away. It has simply been pushed back. The underlying tensions in the Gulf remain, the great power competition remains, and the choke point that is the Strait of Hormuz remains the most economically sensitive 21 miles of water on the planet. If you have been watching WarFinex because you want to understand the world beyond the headlines, beyond the press releases, and beyond the sanitized version of events that the major networks serve you, then you already know that the most important stories are the ones that connect the battlefield to the balance sheet. This operation is one of those stories, and it is not over. The next chapter of this confrontation is already being written in intelligence briefings, in commodity trading floors, and in the strategic planning rooms of every major power on Earth. We will be here to decode it for you, every step of the way. If this kind of deep, unfiltered strategic analysis is what you come here for, hit that subscribe button right now and turn on notifications, because the next video is going to go even deeper into what these Gulf dynamics mean for global energy markets in the next 12 months, and you do not want to be the last one to understand what is coming. The people who see these shifts early are the ones who position themselves correctly. That is what this channel is built for. Do not miss what comes next.